Hi, it's time for another video update. I've tried to time most of my previous updates with an impending top. I think each of them led to a probable 5 to 8% decline, but I was looking for more. With the Jan cycle now actually playing out, and like I've written the last 7 years, and this is the 8th year going, we have seen the first week of January set the highs for the coming months. And I think this time around it might be again a repeat of that. In fact, much more than that, I think we've pricked the bubble now. What I mean by that is that we've got this huge deviation between the small cap index and the Sensex, and that typically occurs when you reach the bubble stage, and the moment that changes, which means the breadth turns down and the small cap index stops running its course. From that point on, typically you get a significant trend reversal, which can almost look like a crash in the short term. This has been seen not just recently, but I think if you go all the way back into the 90s, earlier I used to compare the BSE 200 with the Sensex, and that was made up of smaller stocks or small cap stocks, and whether it's 1994 or 2000, you can see one side runs in the BSE 200 index when the Sensex was closing in on a significant bull market high. So I think we are seeing one of the same situations today. The only difference being that some of the other smaller cap indices have become more like mid cap indices, and the BSE small cap is a better representation. So that's the first thing I wanted to highlight, that the bubble has been pricked, and it's not just a domestic event, it's global. You got an ending diagonal breaking down on the US markets. You got the CRB index decreasing almost 61%, and you got the dollar index starting its 3 of 3, and you have the rupee completing an ending diagonal on the downside. All these patterns have become more and more clear to the point that we can call this a very high probability top. The second thing I wanted to highlight is where do we get speed from here. I think we've not been getting speed on the downside, and there's been a lookout for some kind of event. The chances of that event will probably not be domestic, it will be global, as deflation starts its next round, of course. And two global interesting charts are probably Greece and the Shanghai index, and that's probably where news will come in from, because typically when a market enters the third wave, that's when the worst news comes in. Greece has already started its wave C down for the bear market, and it's already into wave 3 of C. It's sitting on the neckline of a head and shoulders pattern, and it's really interesting that just over a month back, 1.5 months back, when this Dubai news came in, it almost appeared planted, because in a few days we realized that the whole world already knew Dubai was in trouble. So it was not new news, it was just something that had been put together by the media. But the interesting part about that is that in a couple of days everyone observed that the real risk was really in Europe, and among the countries at risk, the primary target was Greece. And one look at that chart today tells you that trouble has already started brewing. So it's already entering wave 3 of C, and bad news could start coming from there. The second one is the Shanghai index, which started its wave C down, made wave 1 of it, and then has been retracing wave 2 for most of the last 1.5 months. Not really going into new highs, but just retracing its initial leg down. So the moment it starts a clear third wave down, I think the other round of bad news could probably start coming in from China. So these are the two places where one could actually expect negative news flows that could cause, or rather speed up the unwinding process. But one look at the charts, I think across the world markets, and on the Sensex, specifically the Sensex, the Indian market today, tells you that the bubble is already pricked, and the air is beginning to come out, and you're going to see the impact of that in the coming weeks at an extremely high pace. So that leads me to the third point. What should we expect from here? I think in the initial leg, when a bubble bursts, you get a knee-jerk reaction, and one should be prepared for a short-term 15 to 20% kind of sudden drop in the leading index, the Sensex or the Nifty, and probably then you might get some kind of retracement rally. Now we don't know What I can't say is that while I'm looking for a 5-wave decline overall over the next 6 to 12 months, whether it's going to be a one-sided extended decline or whether it's going to be 1, then retracement into 2, then 3, and then retracement into 4 in a much more spread out pattern with intermittent rallies. At this point, because you do not have any negative news or events, the chances would be to look for a kind of retracement, kind of 1, 2, 3, 4 breakdown. But if things do start coming in with a lot of negative news flows, then you can also get a one-side sell-off. So I really can't say which of those two will happen. I can only say that it's going to be a 5-wave decline for the Indian indexes as well over the next 6 to 12 months. And that should really mean that this is a time where investors should be completely out of stocks because the decline could be significant. We don't know. There's a lot of debate on whether this is a long-term top or whether this is just, you're just going to get a correction to what happened, to the rally that happened in the 6 to 9 months that preceded us since March 2009. My wave count has always been that this is a bear market rally which leaves potential open for significant declines in the year or years to come, which I've been trying to explain based on the quantitative cycle on the Indian index. And when you look at the impact of the gay wave cycle, basically it's worse off for the world markets because, say, the US is ending an almost 300-year cycle which involves 3 separate K-wave cycles. For India, because we only started economic expansion post the independence, we are in the first 60-70 year cycle, so probably our impact would only be a mild deflation, but all the same it would mean that asset prices would become much cheaper from here if we fall into the same trap. And given that we are globalized, I think the risks of us falling into that trap are pretty high. So for investors, this is a time to be in cash. For traders, it's a time to trade 5-wave declines, look for pullbacks, exit for pullbacks, then look for another 5-wave decline to trade short and exit for pullbacks. I think that's what traders should be doing, and that's what I wanted to highlight, that I think we are at a very high probability short trade here for a significant market decline, and for investors a very high probability or a highly risky state of the market where they should be completely out and probably into cash. That's all from me. Thanks and bye.